The level of Chinese investment in Africa has largely continued unabated, but there have been one or two hiccups along the way. Investment by Chinese firms have largely been centered around resources and infrastructure. Here to discuss the pros and cons of Chinese investment and share his insights on the continent is Stan Lib's Humphrey Gathungu. Humphrey, thanks very much for your time. Well, we've had to buffer some bad news out of China recently, well, perceived bad news, not quite making the numbers anticipated on the industrial production side of things this weekend. And that created the market to pull back, considering that China is again under pressure. Is it impacting investment flows?
Not quite, because China is primarily an investor in the primary markets, that is in infrastructure primarily. So we haven't seen much of a reduction into portfolio flows into Africa because China is not a big player in the portfolio scene in the continent for us.
Humphrey, we've seen obviously Chinese investment very large in resources and infrastructure to support resources on the continent. You've been traveling around the continent. Has it been a net win for Africa, despite some of the hiccups that we referred to in the introduction?
Yes, certainly. I think it has been a net positive because a couple of things that I would say are highly positive. One is that the Chinese investment into Africa comes a lot of enhancements, and two on top of my mind are one, skills enhancements. One of the biggest problems we have on the continent is skills shortage. Similar to South Africa, we have a huge skills shortage, and the investment comes with a lot of engineers, if you like, who help in getting a lot of these projects off the ground in a much more faster way than if you relied on just Africa's own potential. The other thing also is that the Chinese tend to come with their own heavy equipment, capital equipment, and that certainly helps with the capex on the ground in getting some of this heavy equipment into the ground and able to get the projects going much faster. The other positive perhaps I would think of is that we see a lot of these Chinese companies coming with essentially a one-stop solution. Therefore, they come not only with the equipment and some of the specialized skills, but also finance, and very attractive finance, because as you know, China has got huge pools of capital and high level of savings. So they've got a lot of capital that they would like to deploy, and they do deploy that on the continent. So that finance that is packaged onto the deal comes at very, very attractive rates, sometimes very similar to concessionary finance that you get from development institutions. So I would say that is a very, very big positive for infrastructure on the continent.
Nigeria is still one of the brightest spots. Will it continue to be so for some time to come?
I think so. I think we've seen positive trend lines from Nigeria. There's a lot of good things happening. The shift to democracy over the last 5 or so years is something that is very, very strong. And we think that with the improved governance, we will see much more being done, much of the much needed infrastructure being done. Also with the new legislation that is on the cards, likes of the PIB, the Petroleum Industry Bill, and the focus on power. Power is such a big bottleneck in that economy that any focus, any improvement in that will go a long way to improve that. So, and they have the resources. Certainly, they have got a lot of gas that is still being flared that can be diverted into power production. So, I think Nigeria is one of the brightest spots on the continent, and we happily invested in Nigeria.
It's been interesting to see their attitude towards getting that power, problem sorted out. Just lay out the difference for us between the view the Nigerian government's taken on power supply and the involvement of the private sector, and the kind of problem that we have in South Africa with only being able to use so far the state-owned monopoly, which is Eskom.
Interestingly, we see that model where private developers and private capital being deployed in Africa quite widely. In Kenya, for instance, is a very, very widely developed independent power producer who come and fill the gap. And we're seeing certainly the same developing in Nigeria. Because Nigeria, you must remember, the power problem is not necessarily one of production necessarily, but there's huge problems around distribution. I think perhaps even far greater problems around the distribution network. And we've seen the Nigerian government invite private players into that space. And as recently as this year, we've seen some of the distribution networks in the middle part of the country around Abuja being outsourced to a consortium who will, bring best-in-class systems to reduce system losses and also improve collection and also improve on electrification. Because my view is that the production part of it is relatively easy to solve because you can locate the production facilities near the oil and the gas fields. But the problem then comes along distribution, and we see that's where we've seen a lot of the private players coming in.
Consumer. It still is a centre focus or a theme within your Africa portfolio, and it's certainly not going to disappear in the short term.
Certainly, we've been talking about the consumer for quite a while. We continue to love the African consumer, and we've seen the returns in our portfolio certainly coming through from the African consumers. They've performed extremely.
So you've been rewarded for your view.
We've been rewarded extremely well for our view, and we continue to believe in it. And the reasons remain the same. We're seeing the African consumer having a lot more money in his pocket. There's certainly a case for disposable incomes coming up. We're seeing a lot more urbanization, and hence leading to the consumers needing places to shop and more convenience in the shopping. But perhaps the thing that gives us a lot more confidence is the companies themselves, the likes of Nestle, Nigeria, Johanna in Egypt, Unilever. We've seen these companies increasing their capacity in the various markets and increasing a lot of investment in new products and in also getting these products to market quite efficiently, and we like that, and we see them growing. So we see the consumer being both defensive and being both a growth story, because as you know, retail penetration in a lot of Africa is still very informal. So the formalization of that and bring a lot of these people onto the formal chains, I think is still a very good story that has got more room to grow, and hence the capacity expansions that I've spoken about will mean that there's still a lot more room to grow, because some of these companies are still having very low capacity utilizations. For instance, Johanna in Egypt, some of their lines are operating at about 30-40% capacity utilization. So any pickup in demand will flow straight through to the bottom line, and this is certainly a theme that we like.
Humphrey, we had John Oliphant on our show last week, and he was talking about accessing opportunities largely through private equity investments onto the continent. So I wanted to ask you, you obviously invest the portfolio for stand-up on the public markets. Are you seeing liquidity improve? Because John said that one of the constraints is around having the liquidity for a big investor like the Government Employee Pension Fund and others to get into markets and get sizable chunks of these assets. Is liquidity starting to improve on Africa's bourses?
Certainly, we've seen huge improvements over the last 12 to 18 months. We've seen a lot more players coming into the market, mainly from emerging markets and frontier funds that have allocated part of their capital into Africa. We've seen new listings in some of the markets, but maybe just to step back, I think in finance markets, we should look at them as one big market rather than segregating them into private equity and listed markets. And the reason for this is that the private equity will then provide the future listings that we need in the public space. So we're encouraged to see the likes of the PAC and the Public Pension Fund going into some of these areas like the private equity market, because we know that this will then serve to deepen the public markets at some point down the road when they need to exit and when they need to get more capital. So certainly we view them as partners in the African story, and certainly for a large investor such as themselves, they may not be able to deploy the entire capital on the public markets, but certainly if they go into the private markets, private equity markets, and also the bond markets, the fixed income markets, we certainly see that there is sufficient capacity to absorb a lot of these flows.
Is the listed environment changing for the better and rapidly changing for the better? And I know it's very difficult to paint Africa with one brush, but perhaps just particular bourses, looking at the Nigerian Stock Exchange or the Nairobi Stock Exchange. Are you seeing a change for the positive?
Certainly, there's been a lot of positive change both in the regulation of the bourses. I think pretty much all the bourses in Africa are now operating close to world-class standards in terms of systems, all on electronic trading. We've got world-class custodian systems. So there's been an improvement in that. In terms of regulation, I think most of the major bourses are reporting in IFRS and employing other corporate governance measures to ensure that investors are kept abreast of what they're doing, and also limiting the impact on things like the environment. So certainly there's an improvement on that. But perhaps I think the greatest thing is that we should look at the bourses as a mobilizer of capital and savings on the continent. And we see this certainly in Kenya, where the pension regulation is a lot more advanced, and we've seen local pension funds being a significant investor on the bourse. In Nigeria, on the other hand, we're starting to see that coming through. I think the size of the Nigerian pension industry is close to about 21 billion US dollars, and still that is very low in terms of penetration if you look at the number of workers that actually have a pension. So the room for growth is actually very, very big, and the more that grows, the more you'll see that capital being deployed onto the Nigerian Stock Exchange, and then enhancing, you know, the local available pool of savings and sorting out some of the problems that we think that need to be done, like infrastructure. So it's certainly, there's a lot of improvements that we've seen, but a lot more yet to come.